Hello, this is J-Dub here, and today we're going to talk about why deflation, why now. Now, if you talk to anybody about the economy, there's generally two opinions that exist out there. You've got the deflation, which is the one that I adhere to, and then you've got those that are thinking that there's going to be massive inflation due to the out-of-control spending that our elected officials have done, the fact that the Fed has gone out and done some serious money printing. And so what I'm going to use with the help of this kiddie pool here is to illustrate why deflation is really in the order of the day. So when you take a look at this pool, I know you can't see the water inside of it, but it's been out here for about 24 hours. The water is still relatively clean on the inside. But imagine if you had a pool in the backyard and you did not take care of it. And then after several days, several weeks, several years, there becomes a lot of algae and pretty nasty stuff growing on the inside of it. Well, in order to bring that water back into clarity, you're going to add some chemicals, and there's a certain mix and balance of those chemicals that need to exist. And that's exactly what the Fed's trying to do. The Fed knows that deflation is out there, and so they're trying to fight this deflation and bring it back into balance. But they're not going to tip the scales over the edge. They're just trying to bring it back into balance. So really the question becomes, do you think that they're going to bring it effectively back into balance, or are they going to go overboard with it? Now, I think that they're not going to go far enough with it. They're just simply trying to replace a little bit of what's missing. And for that, I've got some charts that I want to show you in order to help illustrate this a bit further.
Okay, so what's missing here? Here we're taking a look at the consumer credit of the U.S. And this data goes back since 1943. And you can see that collectively, since 1943, the amount of credit has just boomed. And if you think about the amount of population since 1943, the population size has not increased to the magnitude that credit has. So there is a ton of credit out there that's been given. And just like what's going on with Greece over in Europe, is once you've overdone it and you've hit that tipping point where you cannot take on any more credit, well, there's only one thing left to do, and that's for the amount of credit to fall. And that's what we're in the process of right now. That essentially, since 1943, the amount of credit that's been extended has been on a rise, with a little bit of a hiatus in that 1989 to 1992 area. So let's zoom in a little bit more. And you can see there that it never really did contract. It more or less just went sideways. And then 1992, 1993, it began its upward trajectory again. So what we're seeing now, this last tail, where prices, or actually this amount of consumer credit is starting to come back down, is the first instance where we've seen of credit really contracting. And that's what's going to make this recession and depression a lot different from the ones that we've experienced since 1950s. You hear a lot of economists talking about, well, this is the worst since the 1950s. Well, yeah, and this chart proves that. And that's why the deflation is going to set in. And let's talk about why that's going to be happening now. So we've taken a look at the consumer credit. The amount of credit being extended is less and is becoming less. And if you recall from the first video that I provided back in August of 2009, that when you talk about credit, or if you think about inflation or deflation in terms of credit, in order for credit to be extended, you need two things to happen. You need a participant willing to accept that credit, and you need somebody willing to offer that credit. And so if any of those two things are missing, then that credit is not going to occur, and you're going to see this chart continue to move to the downside. So why now? What makes now the linchpin of all this? And here's a chart of the Dow back in February, and you could see there was a point where 75% of the days were up days since early February. That took 55 trading days for these prices to move up from about 9,800 up to its high near 11,250. Now, I do think that this high is going to be the highest high that we're going to see. There's maybe a 5 or 10% chance that it could go higher, but it's a very slim chance at this point. So it took 55 days for prices to move up, and then it took 24 trading days for prices to basically come back to where they started. So that's one thing that you're going to see with a bear market, is that prices will drop a lot faster than they rise. And so we may get some up days here over the next couple of weeks, but in essence, the down days, they're going to be much more severe. Like this large down day that we saw was the Fat Finger Freddy day, where supposedly it was a fat finger incorrect trade. It's those types of things that are going to continue to happen in the future. Not that it truly was a fat finger, but people are going to try to blame it on something like that. Now what's interesting about this chart as well is you see this upward sloping red line is a 200 simple moving average. And a lot of large institutions will look at that average as a means of determining whether it's a bullish or a bearish market. And you can see prices are below this line, and it doesn't look like they're going to be poking up here anytime soon. Or if they do, it may be very briefly. So there's a very bearish undertones. We've got this deflationary undertone as well. And so this is what's creating the why deflation, why now. Now, if you prepared for deflation and you've gone out and you've head to the sidelines, you're sitting on cash, you've reduced your debts, well, you're in the catbird seat for the next several years, the next 5 or 7 years. Doesn't mean you're going to be safe, because even if you burglarize your home and you have a great security system, it doesn't mean a burglar could still try to come in and steal. But it just means that you're better off than the average bear out there. And so it's going to be several years of unwinding and volatility here, but it looks like we're very close again for some major significant drops here in the very near future. Well, this is J-Dub. I want to thank you guys for watching, and I look forward to providing you some updates here in the very near future.